Welcome, empowered investors, and greetings from Zagreb, Croatia. So, today we've got an exciting property to talk about, or really not a property, but a portfolio. This is a whole portfolio you can buy. And this is a market that we have been in and out of several times over the 21 years that I've been talking to you about investment properties and talking to you about the most historically proven asset class in the entire world, income property, and the most tax favored asset class in America, income property. This is in the Phoenix metro. It is rare that we are talking about Phoenix nowadays. Why? Because it's gotten so expensive. I mean, look, this is a market that I would have called a linear market many years ago. In about 2005 to 2006, it became what I would have called a hybrid market. But now I would almost even call it a cyclical market. And you know me, I don't usually love cyclical markets. However, I occasionally make some exceptions, and this is definitely one of them. Why? Because Phoenix is cheap enough at times. It's not always cheap enough, but at times it's cheap enough to where the cyclical or hybrid, if you want to call it that, I don't know, it's kind of in between. It's kind of like a hybrid cyclical or a cyclibrid. I'm trademarking both of those terms. Don't steal them, competitors. You're always stealing from me, you competitors. A lot of people have trouble coming up with original ideas. It's really sad. Anyway, it's a cyclibrid market or a hybrid, whatever. Anyway, enough of that. Anyway, this is a market that you can actually have make sense at certain times, and you can take advantage of the next crazy appreciation cycle when it happens. But in the meantime, you can take advantage of cash flow. So here we've got a 16 unit portfolio, and it's four fourplexes. Yes, 4 times 4 is 16. We all know that. Okay, so the total, I'm going to talk about the total portfolio here as one thing. The total portfolio is over 12,000 square feet. It's $2,895,000. The down payment you'll need, and I know we usually talk about much less expensive things than this, but many of you want to buy portfolios. You know, we've got a client who wants to get 40 more houses before the end of the year, or 40 more doors, I should say. And this might be one of those opportunities to help complete that. You know who you are listening, because we've been talking to you recently about that. Your down payment here will be about $869,000. Total cash needed about $995,000, so about $1 million here. Cost per square foot for, remember, Phoenix. This is a cyclibrid market, or hyperlinear. There's another one, hyperlinear. That one is $234 per square foot, which is pretty darn good for a market like this. So the gross rent is projected at almost $21,000 per month, or $250,000 per year. And I am rounding just slightly here. Operating income after your vacancy taken out is just over $19,000 a month, or $230,000 per year almost. And this is based on putting 30% down. This is a 30% down deal, but check out the interest rate. It's pretty darn good at 5.875%. Of course, always subject to qualifying. That's always the rule. Think about this. This metro is ranked as the #1 in the country for semiconductor jobs, investment, supplier expansions. It's estimated that 13,000 jobs will be or have been created from 2020 to 2024. Major corporations, LG, Fujifilm, Corplex, and of course, TSMC, right? With a super famous TSMC that is at the forefront of this incredible semiconductor revolution. The chip fabs in Phoenix are insane. These investments in this market are absolutely mind-boggling by the chip companies. By the way, Scottsdale, which is a Phoenix suburb, right, was my favorite place to live so far. Of all the places I've lived, I liked it better than Southern California. I liked it much better than Las Vegas. I liked it better than Florida, where I most recently lived for the past 6 or 7 years. Okay. Phoenix was my absolute favorite. I only have a few complaints about it, of course. Number one, it's driving based. I don't like driving based communities, but Phoenix does have a lot of little, small, walkable neighborhoods, which is really nice. Florida does a pretty good job at that as well. Las Vegas, terrible. Nothing. Southern California, terrible like that. So you do have that. Of course, you have those hot summers, but as they say, it is a dry heat. And, I don't love the dryness. It's not so great for my sinuses. Anyway, it still was my favorite overall place to live. Nicest people, best social life, and great, fantastic food. A lot of restaurant startup concepts come from the Phoenix metro area. Annual employment growth of 1.3%, adding 100,000 new jobs by next year. So really just an amazing dynamic market. Phoenix is one of these places that just keeps on chugging. It's amazing. Okay, let's keep looking at this property. You've got all your expenses here on the pro forma, your property taxes, your insurance, your management fees. Of course, we still recommend self-management, especially for a 16-unit portfolio like this. Gives you an NOI, or net operating income, of just over $15,000 a month, or almost $182,000 per year. Cash flow, just over $3,100 per month projected, or almost $38,000 per year. Now, let's look at your capitalization, or cap rate, projected at 6.3%. Your total return on investment projected at 24% annually. And you know what I always say, even if it only goes half as well as expected, and it's probably going to go better than projected, because look at our conservative assumptions, the same ones we've been using for 21 years. Well, you've got other promoters out there, other sleazy operators out there that assume your property will have no vacancy rate, or some ridiculous appreciation rate, or no maintenance cost, or no management cost, or some fake understated management cost that really isn't real. Okay. We project only 6% appreciation on average, 8% vacancy rate, meaning you're going to have 1 month per year vacant, a management fee of 8%. We recommend you self-manage and just eliminate that completely, but you can do it either way, and a maintenance percentage of 5%. So 5% is going toward maintenance every month in our projections. And you see how conservative these projections are. And you can do it better than this. You can outdo these projections very likely, but again, nothing's guaranteed except death and taxes, right? This was originally built in the 60s and renovated in 2018. So pretty good deal for a portfolio of properties. Now, I want to share with you what I thought was a really good video about what is called the Great Melt Up, okay, and how to profit from just the massive inflation of asset prices. And folks, I got to tell you, I was talking to Nathan, one of our investors and a longtime friend of mine. He's purchased a whole bunch of properties through our network. I've shared some of his stuff on the show before. He spoke at one of our live events. And right before the election, he said something. He's a really sharp guy, okay? He said something to me that I just totally agree with. He says, I don't care who wins. If it's Kamala, if it's Trump, asset prices are going to the moon, because we are going to have just massive, massive inflationary pressures. And hey, I've been saying this for 21 years, right? Of course, there's going to be ups and downs in the inflation spectrum along the way, but the overall macro trend is up, up, up. Inflation go up, okay? So let's take a look at this video. I think you're really going to get a lot out of this. He does a great job, and this is a great YouTube channel that you should check out as well. But let's just go ahead and dive in.
In our previous episodes, we have established that the Great Melt-Up began on September 18th of 2024. So this is when the Federal Reserve pivoted to an easier monetary policy, which will re-accelerate inflation. So the Fed did this out of necessity to bail out the government's unsustainable debt situation. It does not solve the problem, but it does temporarily make the situation more manageable. So I will tell you what you need to do in order to protect yourself financially. Okay, so let's start with this. Take a look around you, just realize what is happening. Since the pandemic, we have been living through the everything bubble. So even with higher interest rates and quantitative tightening, elevated inflation persisted. Now, with interest rate cuts and soon to follow quantitative easing, the situation will go from the everything bubble to the everything bubble on steroids, or as I have coined it, the Great Meltup. So the Great Meltup phase will be divided into two eras. So the first era will be the Great Meltup pre-crisis, and the second era will be the Great Meltup post-crisis. Now, during this pre-crisis era,
and by the way, I would argue that the Great Meltup, depending on how you define that, of course, started before he says it started. I think it's been going on for a very long time. I think we are just in this phase of just continuing inflationary pressure, because all you have to do is go back to Milton Friedman, where he says inflation is always and everywhere a monetary phenomenon. And monetary means money creation, quantitative easing, or all the different flavors and versions of that. I know QE is not the same as money printing. I understand that. But overall, it's the same thing. It's easing loose money. It's the Fed being dovish rather than hawkish. And that is the world we live in. When you expand the debt by $1 trillion every 100 days, by almost $4 trillion a year, what else could possibly happen, right? You've seen me present the 6 ways I think that the government could get out of the mess, right? Default, sell off assets, et cetera, right? But the game plan they want to play, that they're most likely to play, is the inflation card. That is the best business plan for them. So governments and central banks, this is the business plan for them all around the world, and especially in the United States, because of its special place in the world having the reserve currency. And I know we've talked about whether that or not that's going to last. I say it's going to last a lot longer than you think, okay? But that's another subject. Let's not go down that rabbit hole right now.
Which is what we're in right now. We will see inflation reaccelerate. So this pre-crisis era will end when the government and Federal Reserve manufacture a crisis to cut interest rates to zero and print a tremendous amount of money. So the crisis will usher in the second era of the Great Meltup, and we will see explosive inflation. Now, the second era of the Great Meltup will end when other countries and institutions lose faith in the dollar system. So this will leave the US government and Federal Reserve no choice but to attempt austerity and deflation, which will trigger an economic collapse. So when the collapse becomes unbearable, the government and central bankers will have no choice.
Now, be careful how you hear that last statement. He says, it will trigger an economic collapse. Well, there's many flavors of economic collapse. So be very careful with that phrase, okay? And let's hear his version of it.
Choice, but to enter a new era of US hyperinflation. So of course, hyperinflation will bring the demise of the dollar system, and then we will enter the next stage, the Great Reboot. It will be the birth of a new financial system and a political revolution. But in today's video, we need to focus on how to capitalize on the situation during the Great Meltup. So the meltup stage will last for many years in total, so at a minimum, for the duration of this decade. Inflation will reaccelerate, it will be vicious, and I want you to be prepared. And not just for you, but for your family, for your dependents, for the people that you care about.
Now, most of the advice on inflation is weak at best, right? My advice is the best on inflation. It's use inflation-induced debt destruction. Have assets that are indexed well to inflation, that hedge inflation very well. Of course, income property does that extremely well. And then use the debt against those assets as another kicker for inflation. Remember, income property, or just real estate in general, typically only outperforms inflation by a small margin. It's not that big a deal. But when you leverage that income property, you get the huge multiplier effect. So for example, if you have 10% equity in the property and it appreciates at 6%, and say the government is telling you, which would be about reasonable, that inflation is 2 or 3%, but real inflation is probably double what they tell you. So maybe it's 4 or 6%. So the income property is keeping up with inflation. You're not losing, but you're not winning. But if you've only got 10% equity in that property and you followed my advice about refi till you die, equity stripping, using leverage, right? Hopefully you are keeping your equity portion low, because return on equity is a faulty metric. It's a deceiving metric, as I've taught you about over the years. So what you're going to be doing is multiplying that inflation rate times 10. So that overall return on the property is 60%, 60%, while inflation is maybe 4 to 6%. So now you are outrunning inflation massively. You are massively outrunning inflation. And that's great, but it gets better than that. But wait, there's more, as they say on the late night infomercial. You have inflation-induced debt destruction going on at the same time. So inflation is debasing the balance of your debt, and you're paying it back in cheaper dollars. That's my trademark term, inflation-induced debt destruction. Many, many other episodes on that before. So you are winning the inflation game these two ways. And of course, you have other benefits, because the property is a multidimensional asset class, and it'll benefit from inflation in other ways as well. Okay, so let's keep going here.
It is our responsibility, so yours and mine, to defend the people that you care about, because the government will not provide sufficient assistance when there's an economic collapse. So here's what will happen. This is inevitable. As inflation accelerates, the price of almost everything will go up. Groceries, healthcare, insurance, property taxes, tuition, vehicles, daycare, just about everything.
Well, don't forget,
so inflation will increase
itself.
your expenses, no doubt, right? But inflation will also increase the value of assets. You must protect yourself from inflation by buying appreciating assets.
Yep.
I would prioritize owning a home and stocks. Other assets that you can consider would be gold, silver, Bitcoin.
Okay, so of course, stocks, right? The stocks don't give you the leverage, they don't give you the multidimensional return, and they don't give you inflation-induced debt destruction. So compared to income properties, stocks suck. Okay, gold sucks more. Silver sucks even more than that, right? Okay, so this is like one-dimensional, a lot of this traditional thinking on inflation and how to benefit from inflation. Of course, it's a hedge. Now, Bitcoin has performed really well versus inflation, but folks, don't get too enamored by Bitcoin. I like Bitcoin. I own Bitcoin. In fact, I even mine Bitcoin. I've got a few little miners going on mining Bitcoin, and I think it's great. But you know what I've said? My position has never changed on Bitcoin or crypto in general. It's a very speculative asset class. It has a very short history. I mean, folks, when you're talking about an asset class that has had thousands of years to prove itself in multiple countries and societies and empires rising and falling, versus something that has been around for what, a little over 15 years? I mean, seriously, it is really immature for people to keep trying to compare Bitcoin to real estate. It's just not even earned its place there yet. And from the beginning, I have said the same exact thing. I hope I am wrong. I want to be wrong. I want to see Bitcoin go to the moon, and it may go to the moon, but it might come back down to zero too. We just don't know. Okay. When I got to a certain number in terms of my own Bitcoin holdings, or, I have all kinds of entities. So when I say just understand that that's a very generic comment. Okay. For the lawyers out there. When I got to a certain number, I just said no more. I'm just not gambling anymore. Right. I'm in the game. So if it 20x's or 5x's, I'm in the game. Great. I would feel bad if I wasn't in the game. But you may have a different financial situation than I do. I've got quite a lot of assets. I've been doing this a very long time. I have a high net worth. Okay. So, you can take a little bit and speculate. And I do believe that is a bit of a speculation, maybe the ultimate speculation. I mean, Warren Buffett says it's rat poison, right? I don't know. Charlie Munger said the same thing before his death. So we will see. Nobody really knows where it's going. It's really, really a risk on asset. Okay. So that's what I'll say about that one.
Now, what I told you is a straightforward concept. However, I must state that explicitly because there will be many people with the mentality that the price of homes, stocks, Bitcoin, gold, silver, they're so high, I'll just wait in cash and hope for a crash. So that is logical thinking when the government and Federal Reserve do not interfere with the markets. However, the politicians and central bankers have hijacked the markets since the great financial crisis of 2008. So the financial system and the markets are now completely rigged. Inflation will accelerate and asset prices will continue exploding to new record highs. So we are in the great melt up and you are witnessing this with your own eyes.
And this is going to make wealth inequality much, much worse because there's the investor class and there's the non-investor class. And those who own assets, especially assets leveraged like income property that provides the best leverage, it's the most debt-favored asset class in America. Those leveraged assets, those people are going to do extremely well and everybody else is going to fall behind. So the wealth gap is going to get bigger and bigger and bigger and bigger. And that's a very sad thing. With this show, my mission is to get more people into the asset-owning investor class.
Asset prices, they're not going to go up in a straight line. There will be bumps along the way, but they'll just keep going higher. So here's what you need to focus on. Invest in the stock markets. Whether it's through a retirement account, a tax-deferred account, or a brokerage account, you must invest. Invest in index funds and ETFs that track the S&P 500, but please be aware, as the market soars, you will not get rich because it's all relative. If you want to get rich in the stock market, then you must outperform the markets. But by definition, if you invest in an S&P 500 index fund or ETF, you will not beat the market. You will just keep up. So I'm giving this information to defend you economically. I'm not here to get you rich quickly. So this is a defensive move. And you need to make it a priority to be a homeowner. So I hear many people say that now is not a good time to buy a home. And you know what? I agree. A better time to buy a home was in 2020, or better yet, in 2015, or better yet, in 2011.
Well, how about
in a few years, home prices today will look
that was
cheap.
even better.
And listen, I hear this arguments on why it's better to rent. People say that if you buy a home, it's not really yours because the property taxes are so high, and if you don't pay them, you lose your home, so it's a bad idea to buy a home. So let me tell you this.
So first of all, that's what I've said forever, right? You never really own a home free and clear. That's why you shouldn't pay it off. Okay. That's why you should always leverage your property because you always have a perpetual lien on it through property taxes. You might as well have a lender's lien on it so you get the inflation-induced debt destruction, so you get all the leverage and the other benefits. Okay. The best insurance is a high loan balance. Always remember that.
If you're renting a home and the property taxes on that home go up, your landlord passes on that rising cost to you. But it's your landlord that enjoys the benefits of the rising property value. As a renter, you only get the drawback. And
yeah, so he just said what I've been saying forever, right? Income property is a pass-through entity. He says own a home, but why not own 25 homes? Why not own 200 homes, right? Then you get this benefit multiplied by 25 or 200, right? Build a portfolio. Let us help you do that. That's what we're here for. Go to jasonhartman.com, talk to our investment counselors. We will help you build this portfolio, just like I have with all of my businesses for 21 years, and even before that in traditional real estate, working with investors as well.
Inflation pushes up your rent. If you don't pay your rent, you get evicted and you lose your home. So if you plan on living in a certain location for more than 3 years, then you're better off buying than renting. So those two assets should be your priority, buying a home and getting invested in the stock markets. If you can go beyond that, get exposure to gold, silver, and Bitcoin. If you hate the idea of Bitcoin or cryptocurrencies, I'm not going to try to change your mind. In that case, go for gold or silver.
See, this is where the advice is just so amateurish. I mean, I think this is a great YouTube channel, by the way. We're going to put the link in the description below so you can go and check out this YouTube channel. But this is like the typical financial advisor advice, right? How many people do you know that got rich on gold? Zero. I know you know zero because I know the price of gold. How many people got rich on silver? Zero. Okay. They just tread water. They just keep up. Okay. How many people, got rich in the stock market? Zero. Okay. Now, the only exception I ever hear on that, by the way, is, oh, well, I started a business and took it public. Well, that's not investing in the stock market. That's starting a business. That's a different thing. Okay. Or I traded options. I became this incredible option trader that could beat the market. And, some of those people do beat the market for a while, but just like the gambler going to Las Vegas, they usually end up giving that money back over time. So we'll see, right? But just always remember with anything speculative, whether it be real estate in a cyclical speculative market or cryptocurrency like Bitcoin, especially. Bitcoin is in a class by itself, completely different than all other cryptocurrency, not even a contest, not even a discussion. Bitcoin is different. Remember to follow the sage advice of Kenny Rogers. You got to know when to hold them and know when to fold them. You got to know when to walk away and know when to run. That's a great song called The Gambler. It's a really good song with some really good life lessons.
So regarding gold or silver, you can choose to buy and hold them physically, or you can buy them on the stock markets. Now, let's just say that you want to buy gold on the stock markets. You can buy a gold ETF, which is like buying shares that represent the value of gold. So
and there's a lot of speculation as to whether or not the gold is actually there behind those ETFs. Okay, COMEX, et cetera, all of these funds, there have been just numerous scandal accusations about this. So do what you will, but this is really commandment number 3 when it comes to stocks or non-physical precious metals, right? Commandment number 3, thou shalt maintain control. If you don't maintain control and you're not a direct investor like you should be with income property, you leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Number 2, you might be investing with an idiot. And because of their dishonesty or their incompetency, you are going to lose money. Number 3, assume they're honest and competent. Number 3, they take a huge management fee off the top for managing the deal. And you are going to get the scraps. You're going to get the leftovers. You're going to get what's left over after they take their giant fees. So be a direct investor.
Personally, I prefer to hold it physical, but an ETF is more convenient if you want to sell. But I'll tell you this, if you want gold exposure, I recommend that you do not buy a gold mining stock. So what I'm saying is avoid the mining companies. It's because even if the price of gold goes up, the stock price of the gold mining company can fall if they run their company poorly. Now, I want to be clear. So I'm saying that you must.
But of course, what he didn't tell you is that could happen with any stock, right? With any stock that you buy on the stock market, it's the same exact thing. You're going to lose money if they don't run their company well. If they get massively sued for sexual harassment or patent infringement or antitrust violations or whatever, right? You can always lose money, or if there's just corporate graft and corruption, which there always is. Wall Street is the modern version of organized crime. We all know that.
Invest. However, you don't want to be extreme and be penniless. You need some cash for paying your bills, cash on hand, saving to pay for something larger in the near future. So we're talking about buying a home, buying a vehicle, starting a business, or reserve money for a specific reason. Let's just say if you want an emergency fund. So yes, you will need some cash. However, don't hold an excessive amount of cash, not in this environment that we're facing. So at the time of making this video, you can get paid a 4% to 5% interest rate on your cash.
See, your cash will be debased by inflation, but if you have debt, it will also be debased by inflation. That's why you get the inflation-induced debt destruction on all of your mortgages. And guess what? What if you could get a whole bunch of mortgages without buying the properties? Well, that wouldn't be that bad a deal, really, because you'd still get the inflation-induced debt destruction. The problem is you'd have to pay your own debt. When we buy it as a property, we get the tenant to pay our debt, and the asset itself tracks with inflation, beats it by a little bit usually, okay, as we talked about earlier.
Cash. So that helps to offset inflation on your cash position, but being in cash, excessively in cash is not a viable long-term investment strategy. I would not lock in a long-term CD for 4%. I'm saying that because accelerating inflation will make that a negative real rate of return. Now, this is very important. During this multi-year great melt-up, asset prices will not go up in a straight line. There will be pullbacks, corrections, and crashes. Those are buying opportunities. Don't panic sell, buy the dips. During the great melt-up, when the government and Federal Reserve manufacture a crisis, the markets will crash. But that crash will be short-lived. It'll be a V-shaped recovery when the Fed cuts rates to zero and prints a massive amount of money to rescue the situation. So that will be the ultimate buying opportunity.
And have you seen this trend just over and over? He's absolutely right about this. You see this trend over and over. There's a crisis, whether it's manufactured or not, or maybe they're just complicit in the crisis, or maybe they created it, or maybe it just happened, intrinsically, right? Or extrinsically, I guess I should say. The crisis happens, right? And then everybody thinks, oh, woe is me, it's the end of the world, asset prices are going to crash, everything's going to crash, the economy. And that thinking goes on for a short period of time. And then the Fed comes in to rescue the situation with their monetary policy, and the government comes in to rescue the situation with their fiscal policy. Remember, you got two major levers, fiscal and monetary. And then we see it all turns around. We saw it after 9/11. We saw it during the Great Recession. We saw it during COVID era. I mean, we just see this over and over and over again. It's always the same pattern, and most people miss the boat. Why do they miss the boat? Because number one, they're not in the market. They don't own those properties, or they get discouraged and they sell those properties too easily and too quickly. Or they get discouraged because they're listening to Peter Schiff or some other doomer, right? All these doomers out there that, there's always a Chicken Little sky is falling crisis. And they're just wrong over and over again. And they miss the mark. They miss the opportunity. My friend and our client, Drew Baker, who's been on the show a few times before, and you've heard him, and he has a good saying. He refers usually to Peter Schiff when he says this. He says, what should happen does not always happen. It's like everything sounds good that he says. It sounds like it's really smart. But how is it that he's wrong, just over and over and over again? We did a live stream and Peter was on, and this was a few weeks ago after the election. And we did this live stream and Peter was on rambling and talking. And someone put it in one of the comments, Peter's been predicting the end of the world since 1982. Peter's been predicting doom and gloom since 1982. And look at how many people have become incredibly rich, including himself, including Peter, since 1982, right? So, it's just kind of funny how this stuff works out in real life. In practice, it's often different than in theory. You know that.
If you want to hold some money in reserves for that moment in the future, I don't blame you, but don't hold an excessive amount of cash for this crash, because that could be many years from now. I want to give you a heads up. My next episode will cover what happens after the Great Meltdown, which will be when the government chooses austerity with fiscal policy and the central bankers truly tighten monetary policy. So this will trigger the ultimate economic crash and all asset prices will plummet. But I would say,
but why would they choose to tighten? I can see why they might choose austerity. Now, why would they choose austerity as a reaction to a crisis, right? That's what he's saying. Well, the reason they choose austerity is only because they are forced to. And I don't know that during our lifetime, or even the next generation's lifetime, or the generation after that, I don't know that they'll ever be faced with that choice. Why? Because they can just print their way out of it. They can ease their way out of it. They can loosen their way out of it, right? As long as enough people are buying in to the U.S. hegemony in the U.S. system and the dollar reserve currency system, they can always get their way out of it. They wouldn't have to tighten. They could loosen monetary policy. They wouldn't have to do austerity measures. They're just not forced into this.
Say that's very improbable of happening this decade. So we have time. Until then, get invested and ride this wave up. Please subscribe. I thank you for the support, and I wish you a very nice day. Take care.
All right. That was a great video. I really appreciated that. And we're going to put a link to his channel down in the description so you can subscribe to it, because he does have some great content. On an upcoming show, I've been doing some great research just for you. And also in our newsletter, we're going to be sharing some of this stuff. You'll really like it. And picking out some linear, cyclical, and hybrid markets and showing you what to look for in those markets. Also comparing income to price ratios in several markets. I got some great stuff on that coming up. Probably next week, we'll share this stuff with you. If you're watching on video now, you're seeing some of it on the screen where we looked at some different markets and just compared some really good stuff for you. So until then, happy investing and really appreciate you listening. We are here for you to help you build your portfolios. Our investment counselors are available for you for free. So get a consultation with them. Get a portfolio makeover with our investment counselors. Reach out through jasonhartman.com, and we will be glad to assist you in building your wealth. Until next time, happy investing.